The stock market, as measured by the S&P 500, is currently at an all-time high, which makes it very challenging to try to build a quality dividend growth portfolio. 3 years ago, almost to the day, we faced a similar challenge with a similar valuation in the market. And this is going to be an update on 3 model portfolios that were built. And now, 3 years later, let's examine how they've performed and also talk about how you can duplicate that process in today's overvalued market. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is an update on 3 model portfolios that I constructed August 24th, 2021, in a very challenging stock market. The whole point of the process back then was how you could build a quality stock portfolio even though the market was risky and overvalued. So in today's video, we're going to review that. But first, I'd like to go through what kind of a process we talked about and establish some principles here that I want you to be aware of as you watch this video. So let's go ahead and look at a presentation I prepared. As I said, there were 3 model portfolios built August 24th, 2021, almost exactly 3 years ago. And this was a time when the S&P 500 was significantly overvalued, as you can see on the graphic here, with a PE ratio of approximately 26. It was actually 25.86, and that was near a market all-time high. Now, what I want you to notice here is that the stock market performed very poorly from that point over the next year, year and a half or so, maybe even next almost 2 years out. Okay, and then now the market has rallied again in 2024, and once again we are sitting at almost identical overvaluation. The trailing PE is 24.3 on the stock market today, and again it was 25.86, so we're in a very similar situation. The blue line is a 19 PE ratio on this graph. The orange line is a 15 PE ratio, and you could see that the market typically trades within that valuation range. And clearly with the price, the black line here being significantly above both the blue and orange line, the market is overpriced. So investing in the index itself implies a high risk and also a low dividend yield. The dividend yield is only 1.22%, the current yield, if you bought the index today. Now, as I often point out, it's a market of stocks and not a stock market. So back in August 24th, 2021, as you can see here by the green dot, I was able to put together some stocks. I'm using Abbvie as an example here. And the contrast here was, while the market was overvalued, Abbvie was undervalued. It was trading below both the blue and the orange line. And you can see the performance has been very strong over these last 3 years as a result. It's a market of stocks and not a stock market. And that's building a portfolio based on valuation principles in an overvalued market. And we're going to talk about how we did it back then and show the results. And of course, implied that you can do the same process in today's market as I did back in 2021. Now, there are some caveats to this video that I want to point out. These model portfolios are not portfolios that I would necessarily build for myself. They were built for some very specific objectives. They were constructed based on specific but hypothetical goals, needs, objectives, and risk tolerances, which I'll articulate here. These model portfolios were built based on immediately investing 100% of the money. Something in the real world, I would recommend perhaps a more gradual approach. But again, we were building a model here and building hypotheticals. Also, these model portfolios are presented to illustrate only 3 of numerous portfolio designs that could be implemented. It's the basic principles of value investing that I want to try to get across in this video and those videos that I produced back in 2021. In the real world, there's actually an infinite array of portfolio types that could be built. You can strategize different weightings. You can focus on different types of dividend growth stocks, some that pay monthly. You can look for some that pay quarterly. Again, it's up to your own unique goals, objectives, and risk tolerances. But the central idea behind this video is utilizing these models is to illustrate the process and the methodology of a rational and prudent portfolio construction designed and implemented under the general principles of value investing. As Warren Buffett often pointed out to us, price is what you pay, value is what you get. And we always want to be investing with prudent valuation principles, in my humble opinion. So portfolio construction practices are very simple. Number one, know yourself. This is really important because it's imperative that investors assess a realistic appraisal of their own emotional abilities and tendencies. Investor psychologists have taught us that people feel the pain of loss 2.5 times greater than they do the pleasure of gain. And you got to be able to assess yourself. Can you stand the volatility that's obviously going to come as a part of investing in equities? Number two, establish a plan and follow that plan judiciously and resolutely. In other words, it's great to have a plan, but it's more important to follow that plan. And this is a mistake I often find investors make. They establish a plan and then things come up and distract them and they deviate from the plan and then they expect the plan to still work. Number three, set realistic and specific goals, objectives, and needs. The key here is to be realistic. Don't ask for 10 or 12% yield on your portfolio in a market, in an interest rate environment like we have today, in an average dividend yield environment. There are stocks out there that can pay these 10, 12, and even higher yields, but they're risky and they're not necessarily the kinds of stocks that most people, let's say in retirement years, should be looking for. Number four, diversify properly, not too little or not too much. Peter Lynch used the word diversification if you over-diversify. And great investors like, rest his soul, Charlie Munger, Warren Buffett's partner, said you only need a couple of really well-picked stocks. Both of those extremes are not good. What you want to do is you want to have a portfolio that's diversified enough to protect you, but yet concentrated enough so that you can know the investments and know your own stocks as well as you possibly can. The more you put in a portfolio, the harder it is to keep up with them. Number five is continuous monitoring, research, and due diligence. In other words, you want to manage your portfolio. The portfolios that are built for this video were not managed. They were, I call them Ronco portfolios. If any of you are old enough to remember the old Ronco commercials, it was set it and forget it. Well, that's what we did with these three portfolios just to make a point, and went ahead and took the risk of not managing those portfolios. Number six, no matter what portfolio type or style that you are comfortable with, it should be built under strict adherence to the principles of sound, fundamental value investing. Of course, as Mr. Valuation, I cannot stress that enough. Price is what you pay, value is what you get. And by investing in value at value, you participate fully in the stocks that you're investing in, and you also mitigate risk greatly. It's a lot less risky to invest in ABBVI in August 24th, 2021 than it was the overall market, as you'll see. Now, the basic premises of the three model dividend portfolios that I constructed back in August 24th of 2021 were, first of all three portfolios were constructed to produce more income than the S&P 500. The idea of beating the S&P 500 was do it on an income basis, because if you were looking for portfolios to provide you an income that you could live on, you wanted to basically get a higher yield. The S&P back then was just barely yielding over 1%. Now, number two, all three portfolios were constructed to produce a higher total return, also based on valuation. Again, the idea was it was not that hard to try to beat the S&P 500 when it was so overvalued. And of course, that was really, as I pointed out earlier, emphasized in the first couple of years after constructing the portfolio. And number three, again, as I've already mentioned, all portfolios were unmanaged after build. They were set and forgotten. In other words, set them and forget them. This was just to basically be a hypothetical illustration that could be tracked and followed over time. Now, model number one was an equal weight model for current income and income growth. The emphasis here was you wanted to get higher income that the market gave you, but you also wanted that income to grow over time. Model two was an equal weight growth model focused on dividend growth. Here, we were willing to accept lower current yields for more future yields. So this model number two was more designed for a younger person that, say, had a longer time frame before they needed to start taking income off the portfolio, where model number one was for someone who perhaps was already in retirement and needing maximum income now, but also that income to grow to fight inflation and so on. And then model number three was simply overweighting certain high income stocks in the portfolio so that you could get a much higher current yield and ultimately a better total return. Now that we've established how and what basis these portfolios were constructed back in August 2021, let's now turn to fast graphs and review each of these portfolios. However, let's start by looking at the state of the market at the time the portfolios were constructed and review that once more. As you can clearly see by the fast graph here, the stock market was overvalued. The red dot is approximately the time that the market that I was investing. Actually, I should go to August 27th here, or August 20th. So we're looking at just a real close time, but you get the picture. Well, the market was trading well above the orange and blue line. Now, these lines are the valuation range that the market would typically trade with. When it was low value or reasonably valued, it would be touching the orange line. When it was fully valued, it would be touching the blue line. And when it gets above the blue line, it would be overvalued. And if it got below the blue or even the orange line like it did here, those were really attractive times. So what we had was a challenging market. The market was overvalued. And as you can see from here, from September 3rd, 2021, going to October 14th, 2022, the market actually lost about 20% of its value in that short time frame. Even if I would mark this, and again, I'm just going to try to get these close here. Well, there's the August 27th. If I marked it from there going out to October of 2023, we still had a negative rate of return. That simply shows that the market was overvalued. But the market can do crazy things, and this market has been, we've seen this, what I call long-running bull market here. We had a slight interruption during COVID, which is what you see here. But we had these periods where the market got really overvalued, and we saw what the short-term result was, and now we're back there again. So the principles that were talked about in building these model portfolios back in August are still relevant to today, because you're faced with the same dilemma of an overvalued market again. How can you build a portfolio? And again, I think by applying the same principles that we talked about. So let's go into these portfolios here one at a time. Let's start with the equal weight Model 1 portfolio. And here I'm using the fast graph portfolio tracking feature. Now, this advanced portfolio functionality only works for stock portfolio. It doesn't include cash. It doesn't include any other type of investments you might have. So this would be how you would track your equity portfolio or your stock portfolio. So the Model 1 portfolio had an average annualized rate of return of 7.86%. As you'll see here in a moment, the market itself did about 7.51. So this slightly outperformed the market, but I'm going to argue it did it at significantly less risk. But the idea here was how much income. Well, the current yield of this portfolio is 4.1%, and it actually started out a little bit lower than that. The dividend income has grown each year, so this is producing significantly more income than the S&P 500 would have done. So you've gotten slightly better, or we'll call it equal performance to be fair, but we've gotten significantly more income. If income was your need, this equal weight Model 1 income portfolio would have generated a lot more income for you. And this was about $1 million investment in the portfolio. Now, we can also look at, there's a graphic of how the portfolios performed. This is just gainers yesterday, losers yesterday. These were the top traded stocks. These were any 10Ks or 10Qs or annual reports, any filings that were listed on companies of this portfolio. Down here, you can look at the portfolio in terms of it's 82% large cap, 17% mid cap, but I can click the diversification here, and this gives you how all the different subsectors and sectors that the stock are invested in. This bubble graph shows the ones with the highest dividend yields, and then the ones with the highest estimated growth rate. But then this is a weighting here, and you can look at these stocks. Remember, they were equally weighted when it was built, but now I want you to notice that the weightings have changed dramatically, because bottom line is the stocks that performed the best, Cardinal Health was the best performer, now become the highest weighted. And the ones that underperformed and didn't perform very well are now the lower weighted. But even some of those like Verizon and Telephone and Philip Morris and Altria and others actually did their job about generating income. So let's start by looking at Cardinal Health. This was the best performing stock in the portfolio. By the way, before I do that, though, I do want to show you one thing else. I can also go into the holding section. This was the summary section. I can go in the holding section here, and this can give me the gains and losses. And I do want you to note that there were 3 or 4 stocks that had, well, I'll say substantial losses. Originally, they were $50,000 investments roughly, and some of them are down substantially, like Walgreens, which was a mistake, and we'll cover that later. But then as far as the gains, you had some that had, like Cardinal Health, that had significant gains. And that's what gave us this overall 7.86 rate of return and the high yield. But let's start by now going into the individual stocks, and let's look at Cardinal Health. So I'll start with the best performing one in the portfolio. And what you can see here, once it loads, is that Cardinal Health was purchased where the price was significantly below the line. Now, Cardinal Health had been going through some, we'll call it weak earnings and not great earnings growth. You can see earnings growth was negative in 18, and they have a June fiscal year, only 6% in 2019, 3%, 2%, and actually went down to minus 9% before we started getting double-digit gains, and we could see where this earnings growth then brought the stock price up dramatically. Now, another thing you can do here with fast graphs that I think is very attractive is you can go up and click this button and allow any dates, okay? And then you can go in here and click the calendar, and then you can click this down arrow, and you can go to 2021, you can go to August, then you can go to August 24th, okay? And now what you've got is the performance that this stock has generated since it was built on August 24th, 2021. So now if I go into the performance report, you've got the valuation range here, and you have cumulative change, or you have the compound annual growth rate, which I prefer. All right, so the price action for Cardinal Health was up 28.34% annualized versus only 7.51% in the S&P 500. From a valuation comparison, Cardinal Health was significantly undervalued, where the market, as I pointed out earlier, started overvalued. The market is still overvalued, and Cardinal Health is now trading at fair value. Now, I do want to emphasize that, okay? In other words, Cardinal Health is still trading at between the blue and orange line, but just a little below the orange line. It would still be attractively valued today, and it could be bought today if it met your goals and objectives. I want to make that point. All right, but going back into the performance, I think the real key point here is on every $10,000 investment, remember there was $50,000 invested here, Cardinal Health would have generated $1,150 worth of dividends versus the S&P would have only paid $430. So from an income point of view, you generated a significant greater amount of income. But I also want you to notice that your yield on cost went from 3.79 to 3.83 to 3.87. Now, this is one of the weaker stocks as far as dividend increases. If you go into here, you can see that the dividend was relatively flat. It went from $1.96 to $1.98 to $2. So we did not see a lot of dividend growth in this stock, basically 1% dividend growth. But it did have a lot of capital appreciation potential. So that was the real advantage of that one. Now, moving on to, let's say, another well-performing stock would be AbbVie that I showed in the original presentation. Now, AbbVie, just like Cardinal Health, was undervalued, but it also had a much higher dividend yield. So again, if I go into my Allow Any Dates button, and I'm going to do this just a couple of times so you guys get the picture, and go in here and look for 2021, and then August of 2021, and August 24th. Now I'm measuring the performance, and I'm also going to be able to compare it to the S&P 500. And once again, you see the cumulative change, but I like the compound annual growth rate, so I changed that. And what you see here is AbbVie averaged 18.06%, where the S&P, again, averaged 7.51%. So we had a significant advantage in total return or capital appreciation, but we also had significant undervaluation in AbbVie while the market was overvalued. So the point I'm making here is you took a significant amount of greater risk over these 3 years if you owned the index than AbbVie, but you also made a heck of a lot lower rate of return. So you took higher risk for less return. That's not a good policy. Now, AbbVie had some better dividend growth. We had 10%, 8.5%, and 5% in 2023, and we're expected dividend growth again this year. So once again, AbbVie turned out to be a significantly superior investment than the index itself. Now let's go down here to some of the ones that didn't perform, but I want you to see something. Let's look at Verizon, okay? And Verizon, again, was put in there for the income. And it was undervalued, but then it became significantly undervalued. Now it's beginning to recover, but it had a much higher yield. It had about a 5% dividend yield. So once again, if I allow any dates, if I go into 2021 and then go to August and go to August 24th, now I'm measuring the performance, but here's what I want you to see. It underperformed the market. Okay, this particular holding had a much better valuation than the market. But looking at it from a standpoint of, again, compound annual growth rate, Verizon has so far had a negative 9% compound annual growth rate on price, but only negative 4% on earnings. But here's the real kicker. The total dividends were $1,430 versus only $430 in the S&P. So remember, these portfolios were built for income. We dramatically outperformed the market for income. Now, the question is also, I want to make at this point, make another point to you all. I've always said that a long-term holding period is the minimum of 3 to 5 years. So we're at the minimum holding period now of approximately 3 years. But now we still got 4 or 5 years to go. I believe Verizon is worth significantly more than it's currently trading at. By year end, with a 15 PE ratio, I would put its value at $68. It's only trading at 40. Now, there was a mistake in the portfolio. Remember, this was unmanaged. This could have been handled better if the portfolio were managed. But if you looked at Walgreens Boots Alliance here, it's been a mistake. What we have here is deteriorating fundamentals and deteriorating price, and we even had a dividend cut. But once again, if I looked at performance here over this period of time, and I'm not going to do it the way I've been doing, I'm just going to do it a quick way here. I'm going to just click on it here and click on it here. We lost a significant portion of our money and over a 31% annualized loss, but we did generate $995 in dividends per every $10,000 investment, and it actually still generated more income than the market, but we would have lost money. Now, again, this is simply a mistake, and that's all you want to call it. Now, if you were managing the portfolio, you could have cut it out a lot earlier than that, all right? And then I don't want to go through all of these with you, but you can see by looking at the thing here, you can see the ones that performed the best and the ones that there are 20 stocks in this portfolio. There's 21 because we did have a spinoff of the Warner Brothers spun off, and so it's a minor holding that was spun off from AT&T, which kind of convolutes that a little bit. But anyway, that's the model number one. It ended up slightly outperforming the market on total return and dramatically outperforming the market on total income. Now, moving on to the second portfolio, which was the equal weight growth model. All right, we have a much lower current yield of only 2.3%, but we have a rate of return, annualized rate of return of 9.84%, again, compared to the market that only did 7.51. So we outperformed in every way, by income and by total return. But this was for the younger investor who was looking for growth. Now, from a performance point of view, let's go ahead and go into the holdings here. So just pick another one. Let's pick Cummins, one that I haven't shown you yet. And let's go ahead and do this process that I've been doing. I'm going to do it not as much. So here it was undervalued, above the blue line, but below the orange line when we bought it. So once again, I'm going to allow any date. I'm going to go into my calendar here. I'm going to click the down years. I'm going to click 2021. I'm going to do August 24th. And that brings me to the beginning here. Then when I look at my performance and compare it against the market, I see that we ended up in just about a dead heat. We only slightly outperformed the market on a total return basis. A little better than that, 9.8% versus 8.74 when you include dividends. But the growth portion was 7.76 versus a 7.51. But what I do want to point out here is that the income was $722 per 10,000 versus 430. So I think you're getting the picture now. You can see that this portfolio definitely outproduced. If you go back to the summary, it definitely outproduced the market on an annualized rate of return, and it also outproduced the market on an income, but not to the extent of the others. Now, and just to keep this relatively short, if we go to the overweight portfolio, it ended up having the highest rate of return at 11% and the highest current yield. And again, that included some of the losers in the portfolio that I talked about earlier. We had the Walgreens Boots Alliance in here. And now UGI is an interesting one. I do want to look at it while we're here, because UGI is one where the stock price has fallen dramatically, but the fundamentals, in my opinion, have not deteriorated. And this stock has thrown off a lot of dividend income for us. So the bottom line is, I also want you to remember that if you're investing in the S&P 500, Walgreens was an S&P 500 stock as well. So just by buying the index, you wouldn't have avoided some of these losses. But again, we could have managed these portfolios a little better or a little more closely and perhaps avoided some of that. I'm not going to say all of the loss, but you could have cut your losses a little bit quicker. But anyway, this is the update of 3 model portfolios that were constructed back in August 2021. Now, all of them have been outperforming, and we're at the minimum holding period. I want to emphasize that. We're at the minimum holding period that I think a long-term investor ought to look at. You ought to be looking at a full business cycle of 3 to 5 years. So anyway, I hope you enjoyed this update. You've been asking for the update. But this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation, bringing you this update. Those same principles can be applied today. And I believe that it is not a good time to invest in the index, as the FastGraph clearly illustrated, but you can still be an investor and be a prudent investor and outperform the market for income and even outperform it on total return if you carefully select the dividend growth stocks that are at value today, and FastGraph can help you find those as well as any tool out there. Anyway, I hope you enjoyed this video. I want to thank you all for watching, and we'll be talking to you again real soon. In my next video, I'm going to look at AI stock that I did add to my total return portfolios in my money management firm last week, and it's one of the ones that I think has the most opportunity, so you don't want to miss that. Thanks for watching, and if you haven't already, subscribe to our YouTube channel, ring the bell, give me a like, and also take a look at FastGraphs. I couldn't even imagine investing in stocks without the benefit that FastGraphs offer, and as I like to say, it's the value investor's best friend. Thanks for watching. Talk to you guys again soon.